Welcome back, students who are taking financial accounting and doing the Chapter 1 problem from Group B, 1-37B. This is, Part 2. All right, in Part 1, I went over the problem itself and what I'm going to do. So now I'm going to actually work the problem through. However many videos it takes is however many videos it takes. I have no idea how many there will be. Okay. I kind of figure there's going to be at least 3 or 4, but that's hard to say. Okay, so it says enter the remaining transactions for the month of June into the expanded accounting equation, calculating new balances after each transaction. So let me go down to the next slide here, and I'm going to set this up. So I'm just going to, cash plus accounts receivable plus supplies, and I'm abbreviating, plus equipment due to space. Okay, and that's going to those are my assets, right? So assets, and that's going to equal my accounts payable, which is my liability, plus common stock, right? Plus retained earnings, right? And for retained earnings, remember the expanded accounting equation means, we're going to have service revenue minus our, in this case here, salaries expense minus dividends. Okay, so for retained earnings, as you recall from the other videos, I don't like this thought process. This is equity because the accounting equation is on the balance sheet, but the expanded accounting equation, the revenues and expenses and dividends have to deal with the income statement, and you close out those accounts to your retained earnings account. That's how it gets moved into retained earnings, which is part of equity, which brings the accounting equation back in the balance, because as soon as we make a journal entry, that doesn't affect an asset, a liability, or equity, meaning if we use a revenue, expense, or dividend account, our accounting equation is out of balance, and at the end of the accounting period, we have to bring it back into balance. All right, so first entry is Schultz received $10,000 as a gift and used it to buy common stock in the business. All right. So the first question I ask is, do I affect cash? Okay. And the answer to that is yes. Why? Because the business has had 0 in cash, and now it has, it's increasing 10,000. All right. I'm sorry. It had a beginning balance of, I have to get in right in the beginning balances here. See, that's a mistake I made. Well, that's because I'm just thinking ahead here. But in the beginning of the accounting period, or in this case here, we're in the middle of an accounting period, we already had balances in these accounts. So I have to put those in order to keep the correct balances at the end of the accounting period. So equipment is 32,000. That's going to equal 3,100 for accounts payable, plus 30,000 for common stock, plus 9170, less 4460, minus 0 in dividends. So what we're doing here basically is we're starting out in the middle of the accounting period. We have balances in our, some of our ledger accounts, and then we're going to continue to add transactions. So Schultz receives 10,000 as a gift and is going to buy additional common stock in the business. So the business, when I have a transaction, the first thing I ask is, am I affecting cash? In this case, the answer is yes, because the business is getting an additional 10,000 in cash. Since cash is an asset, right? This is the journal entry. Since cash is an asset and I increase my assets on the debit side, if you don't understand what I'm talking about, go back to the introductory videos, okay? I'm going to debit my cash because I'm increasing my cash on the debit side, and that's going to be 10,000. And since my debits have to equal my credits, all I have to do is just find the proper account to put the credit to for 10,000. And what's happening? Well, we're buying common stock, so I'm going to have a credit to common stock, and of course I'm abbreviating, and that's my journal entry. So my cash, that's what the journal entry would look like, and I would then post those entries to my ledger accounts. So what that would look like is I have an additional 10,000 to cash, an additional 10,000 to common stock. Okay. All right, next entry. B, paid off the beginning balance of accounts payable. Right. So the first what's my accounts payable? Well, the balance in my accounts payable is 3,100, so I know that's going to be the amount for my journal entry. Okay. So the first question that I ask is, am I affecting cash? And in this case, it is, the answer again is yes. But what's happening to my cash? Well, my cash is decreasing. Since cash is an asset, and I decrease my assets on the credit side, I'm going to credit cash for 3,100. Okay. So what's the other half of my entry? Well, what am I doing? I'm paying off my accounts payable, right? So since debits have to equal credits, that means I have to credit my accounts payable. So that's the journal entry. And of course, I'm going to post it to the ledger accounts. Now, since my cash is decreasing, I'm going to subtract out 3,100 in cash, and my liability under accounts payable is decreasing, right? Because I'm paying it off. Now my balance is 0. Notice that I wrote a negative 3,100 here. Remember, the normal balance of an asset is a debit, and the normal balance of a liability is a credit, and your equity is a credit. What is the normal balance? The normal balance is what increases that category of account. Okay? What increases the liability is a credit, right? Well, we're debiting the accounts payable, so that means we're decreasing the accounts payable, which means we're subtracting the 3,100 from it. Remember, debits mean what's on the left. Credit means what's on the right. It doesn't mean increase or decrease. It all depends upon this relationship between the category of account and its normal balance, whether it's a debit or a credit. Okay? A lot of people have a difficult time with that. Okay? The reason why they have a difficult time is because when they see a transaction, they immediately start working with the other half of the transaction. Like in this case here, since it says we're paying off the beginning balance of accounts payable, they might go, and again, I'm just doing this as an example, they start out with the accounts payable, all right? Don't start with accounts payable. The first question you ask is, am I affecting cash? And if the answer to that is no, then you ask yourself, is it affect accounts receivable or accounts payable, right? That's the second question you ask. But start with cash, even if you do know you're going to affect receivables or payables. And the reason why is because people have a tendency to go like this. Oh, well, I have my liability, I'm paying for my accounts payable. Well, I know accounts payable is a credit, okay? And so that's 3,100, and that means I'm going to have cash of 3,100. And now all of a sudden they're wrong. Why? Because they're increasing their accounts payable. They're not decreasing it when they make this journal entry. Okay? Because they started with trying to figure out the last half of the entry first. Okay? If they went and said, am I affecting cash? Yes. And is my cash increasing or decreasing? It's decreasing. then they would know that my credit would be the cash. And because debits have to equal credits, I can back into the debit side, which would be the accounts payable, and it's right. I don't have to think about whether it should be a debit or a credit, okay? Because I'm doing all that thinking when I'm thinking about, my effect on the cash, right? And if you do the cash, I mean, cash is the most used account. So you're getting so much practice, it should just be second nature as to whether you should debit or credit the cash, okay? And then you back into the other half of the entry, and it's automatically has to be right, okay? All right, let's do one more here. So perform services for a client and received cash for $2,500, right? So perform services for a client and received cash for $2,500. Okay, so I have a debit of $2,500 and a credit of $2,500. And so, I'm receiving cash. So cash is an asset, and I increase my cash on the debit side. So I have a debit to cash. Now, what am I going to credit? Well, if I perform services, is that an asset? No. Is that a liability? No. Is that equity? No. That's part of the operation of the business. I'm making sales. I'm performing services. I'm providing a product. Okay. So that would be against my service revenue as a revenue account. So I automatically just back into that. Now, my cash, I'm going to increase it to $2,500. And my service revenue, I'm going to increase $2,500. Okay, and that's all there is to it. Right? So with that, I'm going to pause this video and pick up in right where we left off in the next video.